And a warm welcome to this week's edition of Wealth Quest. I'm Samantha and you're watching CNBC Africa, first in business worldwide. Our topic of the week focuses on funds and their performance in quarter three of this year. Now, it's not advisable to look at fund returns over the short term, but they can provide a glimpse into manager thinking and where sentiment has driven returns. So tonight we'll bring some context to some of the returns you might have seen from the marketplace. Our special guest is a man whose company does the research and will be analysing all the numbers on the show for us tonight. Joining us from Cape Town studios, David O'Leary, director at Morningstar. On the desk with me is our strategist, Cobie, Legrange, strategist at ClucasGray Investment Managers, and Roland, Rousseau, equity strategist from ABSA Capital. Welcome to you, gentlemen, and of course, welcome to you, David. So we're going to kick off with the domestic equity category and looking at the best performers in quarter three there. Investing value stands out, and you're looking at the performance over the period at almost 20%, David. But what do you take away from the top five in this category?
Well, it was a good quarter for equities in general across the world, and even better for South Africa, and even better for the funds on this list. I think the common theme here is that the funds on this list have concentrated their bets. So Investec Value is a fund we've talked about in previous Wealth Quest discussions about how poorly it had performed, and now the reverse has happened. The portfolio manager, John Bacard, has really big position in materials, the mining companies. About half the fund is allocated to that. So it's a big bet that's now paying off for him, and it's a bet that had previously hurt him.
Yeah.
Yeah, I mean, I think the thing that stands out here for me is, we've spoken about John Bicard's fund, the Investec Value Fund, and I mean, it has been a poor performer. The strange thing, though, for me is the fact that you've got this value fund that's starting to come to the fore, but it's during a time when price to earnings ratios for the market is actually running up at like 17s, which is actually very expensive for this market. We're not sitting at certainly at a space where the market is cheap. I mean, have a look quickly at your screen, and you'll see the top equity funds for the last quarter, and there you can see the Investec Value Fund right at the top. That's obviously a fund run by John Bicard, and below that, again, another value fund, Momentum Value, again for the quarter, another great performer, and that fund there run by Sam Hulley. If we go to worst domestic equity funds, there you can see some of those returns. And again, it wasn't difficult to have achieved these kind of returns. Year to date, I mean, resources are down 1%, financials and industrials are up between 15 and 17%. And you can have a look at those returns. Worst one there is in equity technical, which is run by Chris Mayer. And these things go in, kind of swings and roundabouts, and that's how the market works at the end of the day.
Well, what's really interesting is that we've seen the last 3 years have been quite difficult for value investors in general. And this year has certainly been a good year as well, so sort of more of a momentum market than a value market. But we're now starting to see the growth funds at the bottom of the rankings and the value funds at the top. So maybe we're at the cusp of where the market is actually becoming expensive, and the cheaper shares will start outperforming again, and the expensive ones will start underperforming. But
Roland, aren't you finding this fascinating at a 17 PE for the market? Usually a value territory is when the market is cheap and you can find these great opportunities. Certainly there are opportunities, especially if you look at resources as just a general kind of on a super sector level. But the whole market is of a 17 PE, which is actually quite expensive for value managers to actually start performing.
Well, in the last few months, we've seen the financial stocks and the resource stocks sort of do quite well. So the industrial stocks, which had done really well, which are the already sort of expensive stocks, have not done that well. So we actually are seeing a bit of a value phase coming through with cheaper shares outperforming.
Yeah, let's move on to the fixed income space, because looking at the graph there, Ned Group Investments making a return of 2.2%, and of course you compare that to the equity space, certainly a lot lower, still in positive territory, but you've got that as the top performer in that area there. And any comments in terms of the performance in the fixed income arena, David?
Yeah, I mean, what strikes me is just that how unremarkable I think the numbers look there. You look at the spread between the returns on the funds for the quarter. It ranges from 2.2 to 2.1% for the top 5 funds in the category. And if you look down the rest of the category, it's there's not a wide range of returns there, and that it makes sense given the sort of narrow domestic bond market here. And that's about a return that you might expect for a fund in that space for the quarter. So it's pretty unremarkable all the way around.
Yeah.
Yeah, I mean, let's show you quickly up again on the screen just what those funds look like. And these are now obviously best domestic fixed income managers for the quarter. You can see some of those returns. I mean, surprising year to date, all bond is only up about 7%. You're lucky to have received actually a positive return out of bonds, at all for this year, given what has been happening globally in the bond space. Yes.
So you almost take your hat off to those who were able to perform, reasonably well.
Yeah, absolutely. Yeah. And that's I mean, full kudos to them. I mean, here you go, worst domestic fixed income managers, and you can see just returns kind of just in negative space for some of these managers. We are sitting at a cusping point where we're seeing kind of a change in how fixed income will be used in asset allocation. And I mean, good asset allocators would, have thought about this already and would have potentially have now used other instruments for yield rather than trying to use fixed income.
Let's quickly look at the property space. We'll have a more in-depth discussion around what we see going forward from the various asset classes. Just looking at the domestic property equity performance in Q3, the best performing fund on that front, ABSA Property Equity with a 3.2% gain. And then, of course, you've got Sim Property also on that and a few other companies. David, let's take a look at this space. I mean, what stands out for you in terms of the returns that the property sector is managing to deliver?
Well, it is surprising that there's a handful of funds here that the property sector on the whole was down for the quarter, and there was a handful of funds that managed to outperform. It's not a particularly robust universe of names to choose from, and so it is interesting that there still are funds that are able to buck the trend, despite there's not a whole lot of there's not a lot they can choose from to differentiate themselves from their competitors. And it's not all that surprising that we had some negative performance. This is a sector that has returned something in the neighborhood of 20% annually for the past decade. So it's been absolutely fantastic returns from these funds.
Yeah, I mean, even some of the funds in the worst performing category have 5-star ratings, have 3-star ratings. So, of course, you are looking at them specifically. But I suppose, despite the well-managed nature of the fund and, of course, past performance, necessarily right now you're looking at the tide turning for this space. I mean, your thoughts on that?
With the star rating, it's just simply a reflection of how well the fund has done in the past relative to its peers. And it's really not uncommon over a short period of times to see funds with high star ratings underperforming, and then the flip side with funds with poor star ratings performing well, which is essentially what you're seeing on these top 5 lists in the property equity. Over short periods of times, funds can behave considerably differently than their long-term track record suggests. What we think is that over the long term, a fund that typically does well, there's some evidence to suggest that persists over time, and funds that typically do poorly over the long term, that tends to persist. But it's quite a loose correlation.
Listed property, year to date, it's only done about 9%. I think that there's the heyday for property where, and if you actually look at the long-term average return out of listed property in South Africa, it actually beats equities, which is actually ironic because the risk for property is very, very different to what it is for equities at the end of the day. And you might find that how people start utilizing property maybe changes in asset allocation as well, and how they buy them. I think the listing of a business such as Attack, which is really Atterbury Properties, funding vehicle, so to speak, for their properties as a developer, is quite interesting for our market because it certainly couldn't have happened 5 or 10 or 15 years ago, but it's something that certainly comes to market today, which is just it's not a REIT, it's not a mutual fund, so to speak.
Yeah, it is interesting also having that discussion around potentially niche players in the property space still to come to the market. Let's get on to the best and worst performing categories, because we can also throw forward to what we've seen on a year-to-date basis. And Roland, take us through your thoughts on these graphs specifically, with, of course, the resources really shining during this period. And then on the other hand, we had the fixed income, interest-bearing categories, the worst performers.
Look, this is a bit of mean reversion. So we're seeing the resource stocks that have gone through a really tough period doing really well now. Cyclically, that's probably to be expected at some point in time. But what characterizes for me the most interesting thing that you actually can't see on these charts, which is return focused, is that the volatility in our market has actually gone down this year. So we've had very good returns, but at lower volatility, except in the fixed income and property space. So the rand has been a major determinant of the returns in the bond market and in the property market. But what we're seeing in the equity space is higher returns for lower risk, and I'm worried about the sustainability of such a high Sharpe ratio where you're getting fantastic returns with less and less risk.
I mean, year to date, the returns that you've really seen out of the markets actually be quite disparate. I mean, financials and industrials are up like 15-17%, and resources are still in negative territory at -1%. And
so they've still got some leg room to go, potentially.
Yeah, especially if you start normalizing
those
those earnings. And I mean, the big debate in the industry at the moment, I think, is when can you start using a normalized EPS number for some of these businesses? Because quite frankly, at this stage, you know, there's recovery, but it's certainly coming from a very, very low base relative to what we've had previously. Just have a look quickly at your screen, and here you'll see the worst categories, or the bottom categories for third quarter, and you can see there South African real estate for the quarter only up 0.1%, interest-bearing money market only up 0.9%, and South African interest-bearing short terms only up.
We mustn't forget that these returns came with a lot of volatility, so they're very poor returns with high volatility, whereas in the equity space it was the other way around.
Yeah, and just to end off, David, we've got the top categories if you look at it on a one-year basis right now. So we've got global equity certainly being a star performer, 42.5% return there, global multi-asset, high equity. So it's all the global asset categories, equity categories that really stand out in this space. I mean, your thoughts on that? And what you're looking into the global crystal ball and what you see going forward. Any views on the outlook?
Well, I think the story with the global equity is that the rand's depreciated so significantly, and that amplifies the returns on foreign or offshore investments to South African investors. So it's not so much that the underlying markets in the US or Europe or Asia have performed that well to generate those types of returns, but it's been a real good year for those markets, and it's been a bad period for the rand, and that amplifies the returns. Yeah. In terms of going forward, man, it's anyone's guess. It's not what I purposely choose to remove myself from that game because I talk to fund managers all the time who tell me, listen, I can't predict what's going to happen in the markets. What I do is look for businesses that I think are attractive, and whenever it is that the market finally realizes that this is an attractive business, I'll be rewarded for that. But don't ask me when that's going to be.